Markets are no doubt facing interesting times. On one hand, investors are grappling with increasing geopolitical risks, even greater inflationary pressures, and rising bond yields. On the flip side, though, North American economy appears to be fairly resilient, at least so far. So many wait and wonder if the other shoe will drop and what will trigger it. To help us unpack all of this in his insights is Philip Petursson, Chief Investment Strategist with IGM Financial. Philip, it's great to have you back.
Great to be here, Saijal. Thank you for having me on.
So, Phil, if it does feel like there's a lot of unknowns, lots to unpack, as I said. What, if anything, is making you nervous right now?
It's a great question. We've seen a very interesting quarter in terms of market activity that was compounded by the geopolitical risk that we saw between Russia and the Ukraine that's still going on. I would say there's not a lot that I'm overly nervous about right now. I think the market is perhaps putting too much emphasis on some data sets that are coming out or some little factors that they're extrapolating into recession risk or greater economic risk, globally. But when I look at the fundamentals, I'm not seeing that. So largely, I'm actually quite confident in the market as we go forward. I think we know the outcome for the fixed income markets. I have a confident outcome for the equity markets over the remainder of 2022 and into 2023. It's really, when I start to think about some of the risks, it's really in the back half of 2023 or 2024, following all the interest rate increases by the Bank of Canada or the Federal Reserve, that I start to think, okay, I know it takes a while for monetary policy to impact economies. Therefore, what we're seeing today out of the Bank of Canada won't impact the market today or tomorrow or next month. It'll take into 2023. So that's what I'm thinking about. And right now, there isn't a clear picture on where we're headed.
Okay, so you think that impact is going to be a little bit later. Then how big of a headwind, Philip, is inflation still? It wasn't that long ago that the thinking was most of this is transitory because of the supply disruptions. Should we be thinking about this differently now?
Well, I think those that took inflation lightly in 2021 and didn't really understand how the inflation was created do need to rethink their position. So if we went back a year, I was fighting against the transitory narrative, saying, no, it's not going to be transitory. When you flood the global economy with as much liquidity, cash that we saw, 16 trillion was roughly the amount that we saw global central banks and governments inject into the economy, that is going to have consequences. And the consequences of that are higher inflation. So it wasn't used cars that some people were talking about, or airfares, or supply chains. Those were all excuses to mask the real driver of inflation, which is a massive increase in the money supply. So inflation is going to be with us for a while. You have to think of inflation as a locomotive, like a big train. It takes a while to get going, but once it gets going, momentum keeps it in a direction, and it takes a while to slow it down. So the central banks are fully aware that inflation now is more persistent. In fact, I actually think the central banks were on the side of persistent inflation, but they couldn't say it. They had to be very careful in terms of what they said. They had to wait for the market to accept it before they could acknowledge it. Now we're at the point where the central banks are acknowledging it. They're raising rates to temper inflation. I do think they will do a good job of it. I do think that we will see lower inflation, but we're not going back to sub 2% that we saw over the last 10 years. It's probably going to stay in the range of 3 to 4% inflation, for the next, I think, couple of years until we continue to unwind all this monetary stimulus.
Philip, we only have about 45 seconds to the commercial break. On that inflation front, though, do you think that raising rates will actually fix the demand side? Because it just feels like the demand side is really on the essentials that we need.
Yes. Look, I think it will. And I think any reduction or softening of demand or removal of liquidity will have the impact of reducing overall inflation. But again, it's going to take some time. So, the argument is, well, what is the Bank of Canada going to do by raising rates to the cost of oil? Directly, nothing. Indirectly, yes, there are second and third derivatives of that interest rate increase that eventually will work its way into demand in many areas, including oil demand, that should soften that price.